Imagine that you want to buy a house. You find one you like, but you are not ready to purchase it today. So you pay the owner a small fee for the right to buy the house at an agreed price within the next 3 months. If house prices rise, your agreement becomes valuable. You can still buy the house at the lower price written in the contract. But if prices fall, you can simply walk away. You lose the fee you paid, but you are not forced to buy the house. That simple agreement contains the basic idea behind an option. An option is a contract that gives someone the right but not the obligation to buy or sell an asset at a specific price before a specific date. Options can be connected to stocks, exchange-traded funds, market indexes, commodities, currencies, and other financial assets. But unlike buying a stock, buying an option does not necessarily mean owning part of a company. You are buying a temporary contractual right, and that right has a price. To understand options, we first need to learn 5 basic terms. The first is the underlying asset. This is the stock or other asset connected to the option. If the option is based on shares of a fictional company called North Star, then North Star stock is the underlying asset. The second term is the strike price. This is the price written into the contract. It determines the price at which the underlying asset may be bought or sold. The third term is the expiration date. Options do not last forever. Every option has a deadline. After that date, the contract either gets exercised, settled, or expires. The fourth term is the premium. This is the price paid by the option buyer to obtain the contract. Think of it as the cost of buying the right contained in the option. The fifth term is the contract size. In the United States, one standard stock option contract usually represents 100 shares. This is important because a quoted premium of $2 may actually cost $200. $2 multiplied by 100 shares equals $200. There are 2 fundamental types of options, calls and puts. A call option gives its owner the right to buy an asset at the strike price. People generally buy calls when they believe the price of the underlying asset may rise. A put option gives its owner the right to sell an asset at the strike price. People generally buy puts when they believe the price may fall or when they want protection against a decline. Let us begin with a call option. Imagine North Star stock is trading at $50 per share. You believe it could rise over the next month, but buying 100 shares would cost $5,000. Instead, you buy one call option with a strike price of $55. The option expires in 1 month and costs a premium of $2 per share. Because the contract represents 100 shares, the total premium is $200. You now have the right to buy 100 shares of North Star at $55 each before the option expires. Suppose North Star rises to $70. Your contract allows you to buy shares at $55 even though the market price is $70. That right is worth at least $15 per share. The option has become much more valuable. You could potentially exercise the option, or you could sell the option contract itself. But the calculation must include the premium you paid. Your strike price was $55 and the premium was $2. That makes the approximate break-even price at expiration $57. If the stock finishes above $57, the call position may have a profit at expiration, excluding fees and taxes. If the stock remains below $55, the option may expire worthless. You would lose the $200 premium. This is one of the attractions of buying options. The buyer can gain exposure to 100 shares while risking a smaller amount of money than purchasing those shares outright. But this does not mean options are safer. The smaller initial cost creates leverage. Leverage can magnify percentage gains, but it can also make the entire investment disappear. If you buy a stock and its price does not move for 1 month, you still own the stock. If you buy an option and the price does not move enough before expiration, the option may lose most or all of its value. Time is constantly working against many option buyers. Now consider a put option. Imagine you own 100 shares of North Star. The stock is trading at $50, but you are worried that an upcoming event could cause the price to fall. You buy a put option with a strike price of $45. This contract gives you the right to sell your shares for $45 each, even if the market price drops much lower. If North Star crashes to $20, the put option becomes extremely valuable. It acts somewhat like insurance. You paid a premium to limit the damage from a possible disaster. If the stock never falls, the put may expire worthless, but that does not necessarily mean buying it was a mistake. People regularly pay for insurance they hope they never need. Options can therefore be used for two very different purposes. They can be used to speculate on price movements, or they can be used to manage risk. But every option contract has two sides. There is a buyer and a seller. The option buyer pays the premium and receives a right. The option seller receives the premium and accepts an obligation. If a call buyer exercises the contract, the call seller may be required to provide the shares at the strike price. If a put buyer exercises the contract, the put seller may be required to buy the shares at the strike price. This difference is extremely important. An option buyer can usually lose no more than the premium paid, but an option seller may face much larger losses. Selling a call without owning the underlying shares is known as selling a naked call. If the stock price rises dramatically, the seller may need to buy shares at a very high market price and deliver them at the much lower strike price. Because a stock price can theoretically continue rising, the potential loss can be enormous. Selling options is not simply a method of collecting easy income. The premium exists because the seller is accepting real risk. So, how is an option's price determined? An option premium has two main components: intrinsic value and time value. Intrinsic value is the amount the option would be worth if it were exercised immediately. Suppose a stock trades at $60 and a call has a strike price of $50. The call has $10 of intrinsic value. It allows someone to buy a $60 stock for $50. But an option can also have value even when exercising it immediately would make no sense. That additional value is called time value. Time value reflects the possibility that the market may move before expiration. The more time an option has, the more opportunity there is for something significant to happen. As expiration approaches, that opportunity disappears. This gradual loss of value is called time decay. Traders often describe time decay using the Greek letter theta. Theta estimates how much value an option may lose as time passes, assuming other factors remain unchanged. But time is not the only force affecting option prices. Volatility is also crucial. Volatility measures how much the market expects an asset's price to move. When investors expect dramatic price swings, options usually become more expensive. A stock that barely moves offers fewer opportunities for a large option payoff. A stock that could jump or crash has a wider range of possible outcomes. This is why option premiums often rise before major announcements, earnings reports, court decisions, product launches, or economic events. The market may not know which direction the asset will move, but it expects movement. After the event occurs, uncertainty can disappear. The stock may even move in the direction an option buyer predicted, while the option still loses value because volatility collapses. This is called a volatility crush. It surprises many beginners. Predicting the direction correctly is not always enough. The size of the move, the timing of the move, the premium paid, and the change in volatility all matter. Option traders often use several Greek letters to describe these forces. Delta estimates how much an option's price may change when the underlying asset moves by $1. Gamma estimates how quickly delta itself may change. Theta measures the effect of time decay. Vega estimates how sensitive the option is to changes in implied volatility. Rho measures sensitivity to interest rates. The Greeks are not guarantees. They are estimates based on mathematical models. But they help explain why an option can behave differently from the stock connected to it. Two call options on the same stock may react very differently because they have different strike prices, expiration dates, and levels of implied volatility. Options are also described as being in the money, at the money, or out of the money. A call option is in the money when the stock price is above its strike price. A put option is in the money when the stock price is below its strike price. An option is near the money when its strike price is close to the current market price. An out-of-the-money option has no intrinsic value. Beginners are often attracted to far out-of-the-money options because they appear cheap. A contract might cost only a few dollars. But cheap does not automatically mean undervalued. It may be cheap because the probability of a profitable outcome is very low. Buying many inexpensive contracts can feel like buying lottery tickets. Occasionally, one may produce an enormous return. Most may expire worthless. Options can also be combined into strategies. A covered call involves owning shares and selling a call option against them. The seller receives a premium but may have to sell the shares at the strike price if the stock rises. A protective put combines stock ownership with a put option to limit downside risk. A call spread buys one call and sells another call with a different strike price. This reduces the initial cost, but also limits the maximum potential gain. There are also straddles, strangles, iron condors, butterflies, calendar spreads, and many other combinations. Their names can sound mysterious, but each strategy is simply a collection of contractual rights and obligations. The important questions remain the same. What can be gained? What can be lost? How much time is available? What market movement is required? And what obligations could be created? Options were not invented merely for speculation. They help businesses, investors, farmers, airlines, and financial institutions manage uncertainty. A farmer may want protection against falling crop prices. An airline may want protection against rising fuel costs. A fund manager may want to reduce the damage from a market crash. A trader may want to express a view on volatility rather than direction. Options allow risk to be transferred from someone who does not want it to someone willing to accept it for a price. That is their real economic purpose. But options can become dangerous when people focus only on possible profits. A screenshot showing a 1000% gain does not show all the contracts that expired worthless. A premium collected today does not show the obligation that may appear tomorrow. And a strategy with a high probability of earning a small profit can still contain a low probability of suffering a devastating loss. Before entering any option position, a person should understand the maximum possible loss, the break-even point, the expiration date, the effect of time decay, and the conditions that could produce an assignment. They should also understand that brokers may automatically exercise certain options at expiration, depending on the contract and account rules. Ignoring an option until the final day can create unexpected stock positions or financial obligations. Options are not magical machines that multiply money. They are tools for reshaping risk. They can turn a large investment into a smaller defined risk. They can protect an existing portfolio. They can generate income in exchange for giving up future possibilities. And they can create enormous leverage. The same flexibility that makes options powerful also makes them complex. So what is an option, really? It is a temporary agreement about an uncertain future. One person pays for a right. Another person is paid to accept an obligation. Between them sits the market, constantly recalculating the value of time, price, probability, and fear. An option does not predict what will happen. It simply defines what each side may or must do when the future finally arrives.